Welcome to the Beresford Booth weekly webinar. My name is Sherry Bosse Lueders. I'm the chair of our firm's estate planning and probate practice group, and I'm here today to talk with you about Washington estate tax changes in 2025. 2025 is a big year for Washington estate tax. Effective July 1st of this year, our estate tax exclusion amount increased to $3 million. The estate tax exclusion amount is the amount that an individual can pass on to other individuals when they die before Washington estate tax is applied. And a little bit later in this presentation, I've got a few examples to talk through how this works. The other big change to Washington's estate tax is that the tax rates have increased. And let's talk through a little bit about what this means. First up, let's talk about the exclusion amount increases. This is big news in the sleepy world of Washington estate tax because the last time the exclusion amount increased was 2018. From 2018 until June 30th of 2025, our exclusion amount for Washington's estate tax was $2.193 million. It has now gone up to $3 million. The new law corrects a reference in the prior statute to an eliminated federal index. Our estate tax before 2018 was increasing little by little to an index that more or less correlated with inflation. That index went away and our estate tax froze at 2018 levels. So that's one big change to our estate tax law. And the other big change within the increases in the exclusion amount is that annual increases to the exclusion amount will start each year on January 1st, 2026, written to index to a new federal index that hopefully won't be disappearing anytime soon. Let's talk about the changes to tax rates. That's the other big change to the Washington estate tax statute. The new top tax bracket under our estate tax law is now 35%. That doesn't mean that all estates in Washington are subject to 35% estate tax. Far from it. That means that for Washington taxable estates, and I'll be talking about what that is in just a couple minutes, the top tax bracket is 35%. And for comparison, for estates of people with dates of death between January 1st, 2014 and June 30th, 2025, the tax rate was 20%. So we're looking at a 15% increase in the top tax rate. So let's talk about what is a Washington taxable estate. A Washington taxable estate is the estate value after all allowable deductions and after the applicable exclusion amount, which now is $3 million for people with dates of death after July 1st, 2025. I'm not going to be talking about the allowable deductions today. That gets a little too far in the weeds for the purposes of a webinar. Go talk with your CPA about that. But I would like to talk a little bit more about who pays Washington estate tax. The obvious, the estates of Washington residents are going to be subject to Washington estate tax if there is a value in the estate that's above the applicable exclusion amount after all deductions, and the estates of non-residents of Washington who own real estate or tangible personal property located in Washington. So if a Oregon resident owns a vacation property in Washington State, that Oregon residence estate will be subject to some Washington estate tax, although not the full value of the estate. And I'm going to talk a little bit here about out-of-state property. What about out-of-state property? How can Washington tax property of people who aren't Washington residents when they die? And how can they tax the property of Washington residents that's located outside Washington state? Well, for Washington residents, the way that our state legislature has kind of defined the scope of what constitutes a Washington taxable estate, if you're a Washington resident, your Washington taxable estate is going to include any tangible personal property and any real property located out of Washington. Sorry, that's any for Washington residents, their out-of-state property is tangible personal property and real property located outside Washington. For non-residents, so if this is that Oregon resident, their out-of-state property is going to be all intangible personal property, any tangible personal property, and any real property outside Washington. So this is what constitutes out-of-state property. And why that matters is because the Washington tax owed is going to be calculated by applying an apportionment formula that will take the gross estate of the person who passed away, subtract the value of the out-of-state property, so that's those two bullet points at the top of this slide, and then divide that by the gross estate. And that number is then multiplied by the pre-apportioned Washington estate tax. So the idea being, first, the estate tax is calculated as if all of the property was located in Washington, and it's essentially discounted based on the proportion of out-of-state property. Little bit of an aside to today's primary discussion, which is the changes to Washington's estate tax law, but I think it's an important concept to understand that property outside Washington state is still included in your Washington taxable estate, but not the full value of it. It's calculated based on a fairly complex formula here. So yep, this is the estate tax apportionment formula again. The idea is it's the gross estate, subtracting the value of the out-of-state property, dividing that by the gross estate, and then multiplying it by the pre-apportioned Washington estate tax. Let's take a moment here. I want to talk through what the difference, the change in tax rates means. These are the old Washington estate tax table. This is for individuals who died between January 1st, 2014 and June 30th, 2025. And where it has the taxable amount, that means the amount subject to Washington estate tax. So that's the value of the estate after the deductions that might be available to that estate and after the exclusion amount, which before June 30th is $2.193 million. You'll see here that the first rate for that first $1 million subject to tax was 10%, and it went up to 20% for estates that had $9 million and more in value subject to Washington's estate tax. Let's compare that to the new tax table. This is for dates of death between or after, oh my goodness, Sammy, I hate to do this. Can we start over?
Yeah, totally.
Okay, I've just made another, I just see like a pretty bad error here. So let me stop my share. Sorry about that.
That's okay. It happens.
Um, Let me get out of, how do I get out of my slideshow here? And show. I had like a couple other places where I misspoke, but I'm gonna, all right, that's what is out of state property. Here we go. No, this is January 1st and after. What? Hang on. 20. I made a duplicate slide and then I think here, just got to look at this for really quick for dates of death. It should be July 1st. And huh, I thought they were getting rid of the 10% bracket. Interesting. Um, so I'm gonna look at one more thing really, really quick, then we'll
Yeah,
start over. All right, I
no
still have time.
worries.
We're doing good. Table W, calculation of tax, 0 to millions, 10%. Yeah, I thought they got rid of the 10% taxable amount. Okay, I guess they didn't. Okay, I'm going to save this and go back to Zoom. Hello, I'm back in Zoom.
Perfect.
Um, and I am just, it's probably easier for me to just start from the beginning. Sorry.
Yeah, no, that's totally fine. It's actually easier because then if you start over completely from the beginning, I can just edit the prior stuff
Perfect.
out of the video.
Perfect. That's helpful. All right. Then I'm going to do application window, share, and uh-oh. Do you see my little you are screen sharing thing here? No.
No, I don't.
Okay,
But I
okay,
do
good.
see all the little slides, so you're gonna have to
Oh, yeah,
start the
yeah. I'll
slideshow
go to the
before
slide.
you.
Yeah, I'm going to go to the slideshow. Um,
Okay.
slideshow from beginning. Is that better?
Yep, there we go. Perfect. All
Okay.
right. And then
And
just let me oh, go ahead.
just tell me when I should start.
Got it. I was gonna say just let me mute myself. Same thing as before, just count to five, and then you can go ahead and start talking.
Okay, thank you.
Yeah, no problem. Thank you.
Hello, and welcome to the Beresford Booth weekly webinar. I'm Sherry Bosse Lueders. I am the practice group chair for our firm's estate planning and probate practice group, and I'm here today to talk with you about Washington estate tax changes in 2025. 2025 is turning out to be a exciting year for the world of Washington estate tax because there's been a change in our Washington estate tax law. This became effective July 1st, 2025, and the big changes to the law are first, that the exclusion amount has increased to $3 million, and next, that the tax rates for our estate tax have also increased. So let's talk first about the exclusion amount increases, and I'm going to start by explaining what the estate tax exclusion amount is. The Washington estate tax exclusion amount is the amount in which a person can have distributed on their death to under individuals before Washington's estate tax is applied. And the last time the exclusion amount increased was in 2018. That was because there was an old statute that referenced a federal index that could be used to increase the exclusion amount each year. When that index was eliminated in 2018, our estate tax exclusion amount froze at $2.193 million, which is where it was at 2018 and where it sat for just about 7 years. The newly changed law has restarted the ability for our Washington estate exclusion amount to increase each year on January 1st, and it will be tied to what I think our state legislature hopes is a more flexible reference to federal indexes so that our estate tax exclusion amount can be increasing annually without having to go and revise the statute. What does this mean? There's a $3 million exclusion amount now that's effective for any individual who's passed away after July 1st, 2025. And that exclusion amount is also the filing threshold. That means that for an individual who has a Washington taxable estate that's less than $3 million, there's not only no estate tax due, there's no obligation to file a Washington return. It is required for estates that are valued greater than $3 million that a Washington return be filed, even if because of deductions, there's actually no Washington estate tax due. Let's talk about changes to tax rates. That's the other big change to Washington estate tax. There's a new top tax bracket of 35%. And for comparison, for dates of death between January 1st, 2014 and June 30th, 2025, the top tax rate is 20%. So we're looking at a 15% increase in that top tax bracket. I'm going to take a minute before I have some examples of what these increases can mean in and changes can mean in Washington states by explaining a little bit about what is a Washington taxable estate. Washington taxable estate, according to the Washington Department of Revenue, is the estate value after all allowable deductions and after the applicable exclusion amount. So now that's going to be $3 million for people who've passed away after July 1st, 2025. Who pays Washington estate tax? The estates of Washington residents and the estates of non-residents who own real estate or tangible personal property that's located in Washington. That second part can be a little bit of a surprise to some people. If you own property in Washington, even if you're an Oregon resident, your estate is still going to owe some Washington estate tax if you have a total estate value that would subject it to Washington's taxable estate. So if you died after July 1st and you had more than $3 million in assets, even if you lived outside Washington, if some of that property was located in Washington, there's going to be some Washington estate tax due. So let's talk about what constitutes out-of-state property. For Washington residents, so you live in Washington, but you own a vacation property in Oregon, say, your out-of-state property is going to be any tangible personal property and any real property located outside Washington. So if you own a farm in Oregon and $100,000 worth of farming equipment that's located on that farm, that is your out-of-state property. But your house here in Edmonds is your Washington property, as well as your bank accounts and other intangible assets. For non-Washington residents, so this is someone who lives in Oregon and has, let's say, a vacation property in, in the San Juans, all intangible property and any tangible personal property and any real property outside Washington is going to be your out-of-state property. So your house in Portland as the Oregon resident, all of your bank accounts, your car that you have in your garage in Oregon, that's all going to be out-of-state property. And it's just going to be that cabin in the San Juans that you've got as your Washington property. Um, so that is addressed by an apportionment formula in terms of how much Washington estate tax it's due. It's not that that Oregon resident has their entire estate subject to Washington's estate tax just because they happen to own a cabin located in Washington state, but some value that's based on the portion of their assets located in Washington compared to the total assets that they have is going to be subject to Washington's estate tax. So it's a formula that takes the gross estate, so the full estate, and it will figure out what the estate tax would be as if all of the property was located in Washington. So this is called the pre-apportioned Washington estate tax. So you've got your gross estate, then you subtract out the value of the out-of-state property and divide that by the total gross estate and then multiply that by the pre-apportioned Washington estate tax, and voila, you have the amount of Washington estate tax that would be owed by either a Washington estate that includes out-of-state property or an out-of-state resident that includes property located inside Washington. And now I'm going to get even more complicated and talk about our estate tax tables, because I do think this is really interesting to look at the difference, the change in our tax law made in terms of the amount of tax owed. So this was information available from the Washington Department of Revenue website as of the date of this webinar. And under the old Washington estate tax law, and this is for dates of death between January 1st, 2014 and June 30th, 2025, you'll see that the taxable amount, so the taxable amount is the taxable estate. That's the value of the estate that's greater than the exclusion amount after all of the deductions. The first tax bracket starts at 10% when there's less than $1 million in the taxable estate. And when you get up to an estate that has $9 million in or more in value, subject to Washington's estate tax, the tax rate is 20%. Here's our new tax table. And this applies to Washington taxable estates when the date of death is after July 1st, 2025. It starts out the new taxable amount. If it's less than $1 million, it has that 10%. But then the rates start to increase a little bit faster. And when you get to that $9 million taxable estate, you're looking at a 35% tax rate. So let's talk about some examples of how the new tax works. So this is under our new tax law, someone who has a $7 million gross estate. So that's $7 million in total assets. If they had $100,000 in deductions and their $3 million exclusion amount is applied, that Washington taxable estate would be $3.9 million. The rate on the tax table is 19%, and the formula that we're given is $420,000 plus 19% of the amount over $3 million. I did the math in the background here. The total tax owed would be $591,000. This is under the new law. Under the old law, it was actually a little bit more. So someone with a June 30th date of death and a $7 million gross estate, same $100,000 in deductions, but the exclusion amount was only $2.193 million. That meant that the Washington taxable estate is $4.707 million. At an 18% rate, the formula we're given is $550,000 plus 18% of the amount over $4 million. The total tax is $677,260. So you're looking at, under the new tax law, that person with the $7 million gross estate has actually, their estate's paid almost $100,000 less in Washington estate tax, probably closer to $80,000. Let's look at a larger estate though. So here we've got an $11 million estate. So someone with an $11 million gross estate, the same $100,000 in deductions, under our new law with the $3 million exclusion amount, would have a Washington taxable estate of $7.9 million. The rate is 30% at that level. So that would be $1,330,000 plus 30% of the amount over $7 million. This individual would be looking at a total tax, or their state would be looking at a total tax of $1.6 million. In comparison, let's look at that same estate for June 30th date of death. So this is under our old statute. Same $11 million gross estate, $100,000 in deductions, with that old $2.193 million exclusion amount. Under the old law, the Washington taxable estate would be $8.806 million, but the rate would be 19.5%. So that formula would be $1,100,000 plus 19.5% of the amount above $7 million. The total tax would be about $1.452 million. Compare that to under the new law where it's $1.6 million. So here, once you're getting into the $11 million estate, you're looking at, approximately $150,000 more in tax being owed by that estate. So estate planning options, for married couples, it sure makes a lot of sense to continue using disclaimer trusts so that a surviving spouse gets to kind of take advantage of the exclusion amount of the first spouse to pass away. Lifetime giving, since Washington doesn't have any gift tax, is still a really great option for reducing a Washington taxable estate, whether those gifts are to individuals or to irrevocable trusts. Out-of-state property maybe looks a little bit more appealing now. And charitable gifts on death, those would always reduce the Washington taxable estate. This has been a little bit of a whirlwind tour of a fairly complex and technical topic. So if you have questions or want to learn a little bit more about Washington estate tax and some of these changes, happy to discuss with you. Thanks for listening.